Office hours is live. Oh my God. This week has been fantastic. Um, I just love the idea of it's a whole other set of problems when you have to set up an automated strategy that now needs to take advantage of the types of volatility that we're seeing. It really changes the game, and I'm looking forward to talking to you about that later on. But
Sure.
as always, I want to let's go ahead and hit on the questions that we've gotten this week for TradersPost. There's been a couple of good ones. The first set are coming from two from the same user. So we'll
Hmm.
start. So this is AJ Wizard from the Discord group who's asking, if I specify in my strategy that I wish to place an order with 100% of my equity, and if I currently have margin funds available, will it attempt to execute an order using all of my margin funds as well?
Yeah, it's a really good question. So we do not monitor or calculate your margin availability within any type of account. So futures or your options account or your equities account. So that being said, when we say 100% of your equity, we're referring to your available cash balance. So if I have a $10,000 account and let's say another 10,000 in margin available to me, and I go to enter an order at 100% of my equity, that's going to use $10,000 and not $20,000.
Excellent. Which, I mean, that's what you want, I'm sure.
Yeah. Well,
Well,
if you would like to use that margin, however, and you know it's available, then you would specify more than 100%. So if I want to use 25% of my margin, I would say in my strategy settings, use 125%. And that would take all the cash plus 25% of the margin and execute the position that way. If you don't have any margin and you specify 125%, the order would just get rejected by the broker because you have an insufficient balance.
I see.
So if you want to play with margin within an equities or any type of margin based account, you can do that by increasing the value greater than 100%.
And this is because the size of the position is calculated by TradersPost before the order gets executed. Like, it's not perfect, so that we need to know the number that needs to be. We're setting a specific number to the broker.
That's right.
All right. Next up from AJ, who's on a roll here. Say I have 2,000 in Apple and $3,000 in cash in my account, and I set up a trading strategy to swing trade Amazon, so a different ticker. If I select 100% equity when buying Amazon, will it send a signal for 3,000, which is the cash, or 5,000, which is the total value of the account, and then the trade would get rejected?
Right. So inherently, like the assumption I make when people refer to equity is the actual total notional value of their account, meaning what is the value of all your existing positions at market value plus cash? And the two together is what we define as equity. So the answer to the question is that it's going to send the signal based on $5,000, not based on the 3,000 you have in cash.
Perfect. Okay, that's good to know. All right, next up here from AAP. Is there an option to exit all positions at the end of a trading window? This has been coming up a few times, all these different things that people want around the trading windows.
Yeah, and I love it. Please keep that kind of feedback coming. We literally make constant improvements to the software based on this feedback. So we had a few people tag us on that exact type of scenario, and we're actually actively working on that feature now. So it should come in the coming weeks. So what will happen is you can set your trading window, and we'll have a flag that you can send that will allow you to ignore the trading window under certain criteria, whatever criteria you'd like that to be. So that would allow you to enter your position within the trading window, say between 9 and 5. And then if you send an exit signal after hours, and you have this flag enabled, then it would go ahead and exit the position in the post-market session.
I find it so fascinating. I've been trying to use all kinds of different softwares. I've been trying out the Sierra charts. I've been trying out C Trader, and it's funny to see all the different quirks and all the different things that you have to consider with all the different platforms. And every week, it seems I'm getting a little bit more appreciation for the aggregation that TradersPost does, where at the end of the day you go, look, if I'm going to be taking this seriously and I'm going to be doing all kinds of different strategies, it really behooves me just to focus on the one platform, especially when the team is looking to solve pain points for you down the road. Whereas when I have to
100%.
do that in PineScript or CTrader or whatever, I got to think of all these different cases and then figure it out. So I really love it. It's great.
I think a lot of people agree with you. I mean, a lot of our support tickets are around those types of features that eliminate the need for you to write this stuff in PineScript. So the more that TradersPost can do to manage that order after you sent the signal, the better off our traders are, and we'll continue to focus in that direction.
All right, next up. So this person was asking, I am a member of a Discord channel that produces automated signals for trading NASDAQ futures. Is it possible to initiate trades from the data provided in the alert? The answer that we were given them is that, well, we don't connect directly with Discord in that way. But there are some people who are talking about that they have a setup where when they have a bot on their Discord that when a message comes in, it sends a message to Zapier or Make, and then formats a JSON string and then sends that message off to TradersPost if need be. So we don't have a thing that's set up specifically for that for to use, but there are people who are coming up with creative ways and using some of these no-code, low-code tools in order to funnel signals to third-party platforms like TradersPost.
Yep. We would like to see it work in all kinds of different ways. We don't have anything out of the box, but I think in the coming weeks we will be very interested to see how else we can read messages in an automated way. So like Discord and Telegram, I know are really common. Another option might be being able to parse emails as well. So like I think there are some opportunities to do some side projects to see how we might help in that regard. But it'll be something we just kind of look into for now.
Yeah, the stuff I've been seeing around AI, where people are using the language models in order to read the message and then convert that into what it needs to be converted into. That's the stuff I'm particularly interested in because there's ways of dealing with the hallucinations and the falseness. Like you can then have it pass and check something in order to make sure that it gets through, or have micro agents check each other before the message gets sent. And then when I look at like the sort of the hurdles that people have when they're setting up themselves, it's not that much different, right? Some person who's forgetting that they have use signal quantity in their strategy settings, and then sends the message along and then makes a mistake in that way. It's not that much different than what like an LLM might do, an AI system might do. It might even be considerably better if the AI system is doing it. So I'm actually looking to try that out over the next couple of weeks to see, because I want to be like the best PineScript developer ever for automated trading strategies. So I was like,
Yeah.
okay, let's really upgrade this and turn it into something, generate more complex systems.
Yeah, for sure. I like it. And I think you're right. That's a little more of a sophisticated topic on LLMs, but I think the smaller the message is, the more likely that the LLM is able to interpret it properly. But if you had like a huge email with a bunch of content inside of it, gleaning the trading signal from that might be pretty difficult. So I think it might be better to use like Python to scrape the HTML content of the email and then pull out the sections you know are consistent.
Sure. That's current AI though. 6 months, it's going to be able to read my dreams. It's going to be able to read all my past
Yeah,
activities.
I'm increasingly impressed by what LLM can do. So I'm right there with you.
John says here in the chat here, responding to a previous question, it
Yeah.
actually subtracts unrealized P&L from total equity too. I'm not exactly sure what he's referring to here. Do you remember the question?
Yeah. So if we're going back to the does it use 100% of my balance question, when we're talking about how we calculate your total equity, it is the market value of your positions. If you were to take the total shares multiplied by the market value, what I think John is saying here is that we're also incorporating any of that live P&L into your equity as well.
I
So
see.
cash plus live P&L plus the market value of your positions, which
Okay.
I guess is kind of saying one and the same. By saying market value of your positions, we're actually calculating the current price times the number of shares you have, which is sort of the same as including your P&L. But John is actually saying we subtract that P&L from the equity to kind of start from your original balance, or the real available balance that you have.
Understood.
Right. Sorry. So John's following up. It's not actually including market value. It's the quantity times the cost basis. Correct. So it's subtracting out the P&L So thank you, John, for clarifying. Tricky nuance to all of this, but what I can say is, unless you have like a massive, sort of current profit in a trade that you have right now, and you want that incorporated as your equity, maybe that's a tricky situation some users might get into. Like if I have a Microsoft position and I'm up 50% on it, and you're not including that as part of the equity calculation, then really it's based off the cash I had when I started that Microsoft position plus my available cash. Is that correct, John? He's in chat right now, so we're getting the. Maybe we'll circle back on that one and
Sure.
discuss the nuance of equity later.
All right. So the next question here we have is, why don't my previous trades appear on my account dashboard? And so the account dashboard in TradersPost, that one shows the trades for that day. You have to go into the subscription trades in order to see all the trades that happened for that subscription.
Yep, that is correct.
This is a question I've added in here just to some salt in the wound here for some people. If I have a strategy that has a high percent profitability and profit factor with a low max drawdown, does that mean my strategy will make me money? No,
I mean,
not necessarily.
Is the question associated with the idea that this is the back test that you did? You haven't done any kind of walk forward test yet?
That's right. This is all in the backtest scenario, and I put this in here because I get it essentially all the time. In fact, we even see it on the different signal groups and on our server, where people go, "Well, the strategy is good because I have a high percent profitability, high win rate, and a high profit factor. My max drawdown is like 5% or less, and so now I'm going to run this, and I'm going to become super wealthy." And the issue there is what Mike brings up constantly is that your future data doesn't necessarily, it's not exactly one for one with your back testing. Case in point, the volatility event that we had just this week. There's always things that can happen that changes the distribution of outcomes, and
Absolutely.
you can't guarantee the outcome. And so it gives you a pointer that, hey, maybe you might want to test the strategy, but there's no guarantee that it means you'll be successful.
Yeah, and I think it's also fair to say that like testing window makes a huge difference. I think one of the biggest flaws with backtesting on TradingView is the limited trading window by which you can run tests. Yes, there is the deep backtesting system, and it does go a little bit further back. But the longer you can actually test your strategy, especially if you're doing intraday, which I know many people are, over a longer period of time, the more likely it is that you're going to incorporate some of those strange deviations in market activity and behavior. And if your strategy still stands up over that, then you can gain a lot of confidence, of course, that you've built something that's pretty robust. But a lot of times, I think, if people are on lower account tiers with TradingView and they're not using the deep backtesting system, they're basically testing on 5,000 bars of data, and that doesn't go back very far. So there are many situations in which you could be testing your strategy in a really low volatile environment, like 2 weeks ago when the VIX was down in 12s, in the 12s, and your strategy looks fantastic. It looks like it stands up really well, and then boom, the Japanese market raises interest rates, and you see volatility like you haven't seen in 12 years, 14 years. That volatility spike was one of the largest we've seen in a while. So it's I think it's important to realize that robustness comes from the history that you test against, the number of trades you're testing it against, and making sure that you've really covered all the different types of market regimes.
The thing that has now been drilled into me, now it's my mantra, and we see all the time in the trading bot session videos that you do, and that is risk management. Like
Right.
the risk management is the thing that helps prevent you. It's your insurance policy. How is it that you're going to deal with the unexpected, the unknown unknowns, and the known unknowns? If you're not accounting for that, it doesn't matter. You can have a strategy that's running really well for a while, and then one trade can completely blow you out.
Yep.
I find it to be just fascinating. I saw someone in the Discord group where they confuse the quantity. They were confused some sort of a variable where they thought it was the amount of dollars they were going to be spending, but it was actually the number of shares they were going to be purchasing. And so then it actually sent a signal in a test account. They send a signal to purchase like $9 million worth of shares. And they're like, "Oh man, I didn't even realize." Well, yeah, because you had a misunderstanding where you initiated this thing, and they're like, "Well, the strategy's fine," but when they actually connected it and they set up the JSON payload, it was the wrong information that was sent. And I see stuff like that, and I go, human error, volatility in the markets is always these points where something can go wrong, and without having that, that's why for me, my risk management is always first the amount of money that's in the account. I can't lose any more than what's inside of that account. So I never put anything more than, if everything went belly up, that okay, I'd still be fine. So I'll have like 5 different accounts just to make sure. And then I used to be so against stop losses or any type of mechanism that would get me out of a trade that would still be profitable. And until I realized, you start to understand it's the number of trades. It's not the one winning trade that's going to make you everything. It's the series of trades over time. And if your strategy can't abide closing out a winning position, you're still in profit, and fine, you didn't get all the profit you could, but you still got some profit. If your strategy is not like accounting for that over time, that you're making this money over time, then what do you really have? You have a thing where you're waiting for luck, essentially, to be on your side. And the final thing I'll say is that the amount of times I'll have a client who will show me a strategy, and I'll be like, okay, this is a great strategy, great results that you're seeing instead of backtester. I go, now let me just change the date ranges. I'll go and I'll change the date ranges to something from like 3 years ago, some other random period, and the numbers are terrible. I go, how did you get those numbers? I literally just ran it on a different period, even in the backtest. And they go, oh my God, so it's not a good strategy. No, because you only tested it in an uptrend in this asset and never in a consolidation or a downtrend.
Yeah.
Their mind gets blown.
Yeah, and of course it's frustrating. I mean, like, I don't want to underestimate how difficult it is to come up with a winning strategy. It is incredibly difficult, especially on lower time frames. Where there's a lot more noise in the market. It's much more difficult to get something that accounts for the massive swings that can take place, the volatility changes that can take place, and it is discouraging to have put together a strategy that seems to be robust and you're very happy with the results, and then you run it on a walk forward test and it falls apart. It just doesn't work, or it doesn't stay profitable in a paper trading account over some number of weeks. We don't ever want to just look at like one trade and say, oh, this doesn't work, I'm walking out of here. We do want to give it the time to actually execute, but I understand how discouraging that is. I've been through that myself, but I think that is where you realize this isn't really a like, the mission is to always be seeking new ideas, to constantly try to tweak and refine and get another expression of the market running, and then pair that with the things that are currently running, because at some point, what you have now is no longer going to run anymore, or it won't be as successful as it used to be. Something's going to change about the market that will sort of dissipate some of that performance. So that the journey is constantly looking for great trading ideas. And I think if you get motivated by the idea of constantly coming up with ideas, and you're passionate about how to look for those ideas, that's where the whole process can be very rewarding. At least that's the journey I had to take. I think for a while I was like, nah, maybe trading's not for me. And then I was like, but wait, what if I looked at it this way? Wait, what if I looked at this market? Oh, I've never been here before. What about leverage? Oh, okay.
That's right.
Yeah.
So I think, okay, how once you talked about this a few months ago, that where people they refer to alpha, but it's referring to the wrong thing. Like they just mean they have
you're just
their
getting
leverage
rewarded
beta.
for additional risk. Yeah, leverage is really just, or I'm sorry, in many cases, what you think is alpha is just leveraged beta. You're just taking increased risk in your returns.
Yeah, and as soon as I accepted, at least for myself, actually from what I've seen, I'm not really seeing anything that's not leverage beta. Like, because it's so hard to beat those types of returns when you actually do succeed. So then I was like, okay, how do I take those leverage bets and still be, as opposed to being like, I mean, I remember sitting on earnings calls and going through reports from the companies and trying to figure out myself, oh, is this this company undervalued or overvalued, and trying to make bets accordingly. You go, the 90s are over, like that's done. We're in a leverage high beta world, and that's the game I want to be playing.
I think that's totally true. Anytime I see anything that outperforms the S&P 500, I automatically assume that there's leverage involved in some way.
Yeah.
It's just increasingly difficult to come up with a strategy that can beat the market without leverage.
Peter's asking here, just a quick question. Is there a strategy that can all but guarantee a daily profit of $5? I've had variations of this sort of thing all the time. I've had people try to hire me, build me a strategy that guarantees me 1% per day. And I said, well, I can't guarantee you 1% per day. And they're like, no, you can't just guarantee 1% per day. So I developed a strategy for this one guy, and it was doing on average 1% a day. And so I was like, okay, that's good enough. And he goes, no, I want 1% every single day.
Right.
I said, what? Not even an average? He's like, no, cancel the contract. He's like, I'm not doing this anymore. I wanted 1% per day. I was like, well, I can't do that.
I'll give it to you. Here's the strategy. Keep buying treasuries, but have a lot of cash available, and you'll get exactly the return you're hoping for. Like anything with a coupon rate, anything that's actuarial or annuity based, sure, I think you've got an opportunity to get the exact returns you're hoping for. But in many cases, you're going to need a lot more cash in order to pull that off. It's a process to find something that is low volatility, sort of low beta, if you will, that returns consistent results over and over again, because markets aren't consistent. So it is very difficult to get a guaranteed daily profit of any kind.
Yeah. Actually, I didn't even think to tell them bonds that works, or even I like the idea of staking crypto. I've always found that to be fascinating. A type of
Oh yeah, sure. Another kind of bond, essentially. I mean, staking
exactly.
crypto is like basically letting people borrow your existing crypto at a coupon rate.
That's right.
Yeah.
John followed up with an answer here. He was saying, if you have 100,000 account and 50,000 of it is on Apple, and then Apple goes up 100%, now your total equity is 150,000, but 50K of it is unrealized. So if we use unrealized gains in the calculation and you use 50% of total equity per position, then it would calculate a quantity with 150K and it would be greater than the 50K, which is the cash available in your account.
Okay,
So
totally makes sense. So that would actually require that you have 75,000 in cash available in order to execute the position. What about the inverse situation? If you're subtracting out the available P&L, then if I have a $50,000 Apple position and it goes down by 50%, now I've lost 25,000 K or 25,000 in unrealized losses, but I still have 50,000 in cash available. Is it still only calculating half of 75,000? We'll let him follow up on that one. I like the silent replies. We need to bring John in on these for sure. We'll make sure that he's part of this, so it's a little more of a real time discussion.
Well, he's been messaging me. I've just been ignoring his messages and not letting him.
So Peter asks, because I made a comment earlier, what does another expression of the market mean? And I think that's kind of, we'll call that the we'll call that a Mike phrase, if you will. I don't know that anybody else calls it that, but basically my interpretation is that you're going to get different types of returns depending on what kind of exposures you buy. And by an exposure, I mean different types of asset classes, different types of instruments, different types of ETFs or stocks, or you might fold in bonds, or maybe you have futures in there somewhere. But the expression of the market is basically your way to expose yourself to the risks of that market. And that might include multiple markets. It could be the US market, it could be emerging markets, it could be the crypto asset class, which is more of a global context. And that exposure, I think, gives you a different type of return stream, or what I would refer to as an expression of the market. Because if you're looking at the whole market as in totality, there's really not a trade that I can think of that gives you the entire market, right? Like the whole treasuries and different currencies and different cryptocurrency, all the cryptocurrencies, all the ETFs, all the emerging market ETFs, and so on and so forth. It is, if you were to wrap all that up together, it'd be very interesting to see what the returns, the equity of that would be. By the way, is it really stable? If you buy the whole world, is that a really stable return? So I guess my interpretation of expression of the market means what you're personally filtering down to, because that often is what trading and investing is basically eliminating what you don't want to trade and own, and just getting to the things that you care about most. For me, I care about tech stocks. I like XLK. I like NASDAQ futures. I like holding the SPY. And sometimes I'll do some hand-picked stocks. But that means I'm ignoring 90% of the rest of the market. And that is my expression of the market.
Excellent. Yeah, Peter says that's a good Mikeism. We'll accept it.
Perfect.
John answered previously with, yeah, it subtracts the P&L positive or negative.
Okay.
Excellent. Okay, so we'll leave it there for the questions for this week. We're going to roll right into after hours because, I mean, the events of this week have been absolutely fantastic, and I'm here for it. We're both here for it. Just give us a second. We're going to do the fancy switch to after hours.
Look at that new show. We took a commercial break and everything.
Look, now it's like completely different. Now we're completely different. We're soft. All right, so here I want to start off with this.
Okay.
We've had the it sort of feels like a Tom was right type of situation, which is what I enjoy. So we had the largest single day intraday rally in the VIX and the largest decline single day in the VIX, both in the same day.
Yep.
Which is just beautiful that this sort of thing can happen. So you take a look at the different types of actually, let me just show it on the screen here. All right, so this is the VIX August 5th. And then we compare that, let's say, to this is the COVID, but this happened over a period of exactly. Oh, I think it was like 2 weeks almost.
I was at my desk the whole time it happened. Yep, I remember.
And we've had other volatility spikes, but again, none of them were single day. So we had the Volmageddon over here. We had the Chinese yuan deval, 2011. There was
the flash crash in 2012.
Right.
Yep.
And then the well, this is all reverberations from what we had from the global financial crisis over here. But I mean, we've not seen anything like this. I mean, from the lows of volatility, which is always from the lows. It's always from the lows of volatility. You never see it like climb bullishly and then spike up. It spikes up.
Yeah, it's interesting.
One day.
I love this chart here, by the way, because this is, again, I think something that we should constantly be considering, especially when building strategies over the long run. There are always these really slow tapering down periods of volatility, followed by huge spikes in volatility. Every instance you can see here where volatility gets down into the 10s or 12s is followed by some kind of an event. And honestly, this scenario I'm describing, I think, plays a role where people start to develop strategies or they start to trade in markets in these really tight volatility zones where ATR is low, generally low. Intraday activity is fairly manageable. There's not huge drawdowns within the beginning of a day. It's easier to trade those periods of time because price doesn't chop around as much. And then all of a sudden, there's more and more and more market participants that are trading this tight zone, and they're all feeling really confident. Everybody feels like a genius because everybody's making money in a bull market. And then there's a volatility spike, and guess who gets trapped? Everybody who's trading in these really, really tight zones. I can't say that I predicted at all where this volatility zone was coming from, but I'm telling you, for weeks now, I've been looking at a VIX of 12 and going, we're going to see something. Something's going to be a catalyst.
So what happens is with these, which is so fascinating, what happens when you have these periods like you were just describing where the volatility is ebbing lower and lower and lower. And so what happens is that once you have a trend, then you have the people who come in to take advantage of that trend. So what are people doing in those low volatility regimes? They're selling vol. They're selling vol. They're collecting the premium on that because they're going, well, it's been going down for the last year and a half. And if I sell it, I know I'm going to have this guaranteed return of these premiums. But then it gets to the point where it's essentially maximum complacency, where there has not been, it's so strange how people think there has not been a volatility event in so long. They go, well, tomorrow should be fine.
It should be good.
And it's
Yeah.
exactly.
Yeah.
Then this window of happens, a catalyst occurs, and then you have where everyone's on the wrong side of the boat. In fact, it's not unusual. If I'm not mistaken, I think a bunch of these volatility spikes in the VIX happen in August. Because it's exactly the period of time where people are away on vacation. They're not
Mhm.
really paying attention. They have these automated systems set up, and then boom, something can happen, and then it could cause a catalyst. I think even Bear Stearns collapsed in August, if I'm not mistaken, before the
It could be.
GFC.
Yeah. It's a good observation.
And so you get these spikes, and so but what's fascinating to me is that so we've been talking about zero dated options, and which causes it causes gamma to go crazy when the volatility spikes happens intraday. So you can imagine over a period of days, like we had with COVID, where volatility as a measure of uncertainty. We're like, we don't know what's going to happen, and so volatility, like, it spikes and then it rises, and then you have this volatility regime for a period of time. But here, the with the zero dated options, what happens is that once they get into the money, those options, because they're zero DTE, the gamma on them are so high, which means that as they get into the money, they go into the money drastically, way higher, like a lot faster, and that causes the market makers to have to sell the stock, they sell the futures in order to keep their books balanced. So it drives on the price. The increased value of the puts drives on the price, but then because there's zero DTE, they close out at 3 o'clock. Or you can't get any more after that point. And so then the puts get monetized. And what happens? Well, then the market makers have to buy back the the positions that the hedge positions. So then we have this spike up, and we're going to see so much more of this happening again and again and again and again because of how cheap short dated options are, how mispriced volatility it becomes, and how big of a magnitude of these moves can actually occur.
Hmm.
So I'm expecting this to be this type of thing not to go down in history August 5th as a, oh my god, remember the vol spike? I'm expecting 10 more of these over the next 2 years at even higher amounts. And what we saw in the Nikkei, the drop of 25%, we're going to see that in the bond market. We're going to see that in the stock market. We're going to see that in all kinds of different places where we're going to have these massive volatility events. This is what I'm expecting, and I felt very vindicated with this.
Hmm. Don't you think that the market's reflexivity, response or reaction to events like these might change the way that we start structuring trades from here on out? Like, to the point of getting trapped in this type of environment, people only like getting burned by the oven one time. So what changes about the way we manage capital after this point? Everybody's we've already observed a big flight to safety. The bond market went crazy from this. I think people are moving to more positions of safety and will slowly dip their toes back into the market over time, which leads me to believe that maybe volatility won't be as aggressive because it takes a long time to convince participants that everything's fine. You're not going to get burned again. That takes, 2-3 years before people get trapped in this type of scenario again. As we saw with the VIX chart, just looking at the VIX historically, there are these long periods of time where it feels like market participants feel safer and safer and safer to add leverage, to tighten their stops, to maybe put on trades that are extremely risky, and they're doing it because they believe that the market isn't biting them, and then out of nowhere it bites them.
So what I would imagine happens is there's this trend that's happening now, you've probably seen as well, where in order to express a long or short position, instead of being long the stock or short the stock, more and more people are owning the options on that. They're owning the calls, or owning the puts. And so as people are not sure what's going to happen in the future, so for example, if you're not sure what's going to happen with the election, you might decide, well, instead of I want to be exposed to the upside potential of the market, but I want my downside to be capped. Well, then what you can do is to buy the options, and then you can have options on different time frames, and still be exposed to the upside potential, plus your upside to the convexity. And so that's how I would feel if I'm expecting liquidity to be pumped into the market because it's an election year.
Mhm.
Well, why just be net long the stock? I might as well be maybe have some stock position, but have 20% of what I would actually put in long dated calls, because then I could just be writing that into whatever they're going to decide to do with the pump of the market,
Mm.
and I'm only and then my downside is limited. But also here, what seems to be happening, especially for retail traders, if you're going to take Reddit and Twitter as an indication, is that the zero dated options, the short dated options, are so cheap that it's almost silly not to own them, because for a small amount you can 10x 100x your money if you do it in these periods of weaknesses. And then these periods of weaknesses are becoming more and more predictable. We know there are periods of weaknesses, liquidity weaknesses, I mean, where volatility isn't well supplied and there's a downturn or upturn in liquidity. You have these periods where every quarter, it seems, every quarter there's this window, this 2 week window where vol isn't very well supplied because it's being rolled over. Quarter end is closing out along with month end, and if you're going to take a bet at all, it's during these 2 weeks you want to be doing it. Then if you wait till volatility has been low for a little while, then if volatility has been low for 6 months, well, give it a shot. Give it a shot on the next quarter expiration, because chances are you might make 100x your money on that. And so I would expect more and more people to participate in these things, especially as the returns for these days start propagated around. People go, wait, you made how much in one day off of how much did you put down? What am I buying $100,000 worth of Tesla hoping that it goes? Why am I doing that? I might as well buy the options instead.
Okay, I see your point, and I think it's definitely a market that I haven't done a ton of research in to understand its correlation to the rest of the market. I understand the mechanical aspect of why it impacts the equities market and even the futures market directly as we close out these contracts each day. And I think we've also observed that zero DTE contracts are becoming increasingly popular by the retail crowd, and as a result, that activity, I don't expect that activity to slow. So I hear your point. Like, that desire to constantly be in these contracts and be buying lottery tickets every day is sort of how I would look at it. Is a contributor to the ongoing spikes in volatility that we won't see coming.
That's right.
Okay.
Peter is asking here, how does the U.S. debt factor into my analysis on that, or is it a non-issue? No, that to me is bullish. It's bullish as all heck, right? The debt, these governments around the world do not want to. They're not going to default on their debt. The Jenga system that we're in requires more and more and more debt, and so because we know the response function of the governments and the central banks, that they will supply liquidity. If liquidity is low, they will support the value of the collateral so the financial system doesn't go under. They will make sure that spending from governments for whatever the program is going to continue. Then you already know what the other side is going to be, and all you need to do is survive the volatility event, right? So you can either be placed with the place your short dated options. And I'm saying zero DTE, but it could even be 2 weeks out, 1 month out, whatever it is. You can place that, and you can benefit on the drop, predicting the drop, or you can wait till the drop and then definitely buy calls, because it's not gonna. I mean, we're not going to stay at a low nominal value on the equities market. That's just not going to happen. They're going to print the money. They're going to issue the liquidity. So the spike happened. What is it? They must have rushed. Who knows what happened behind the scenes with the issue with the Japanese market? They're going to pump that liquidity in order to make sure that the whole Jenga system doesn't fall down, and you can bet on that with short dated options and clean up, or crypto, which is a long dated call option on
Right.
the liquidity
Right.
market.
As we've
Actually,
discussed in the past.
so I wanted to play this this video from you for you from Kyle Bass, just recapping essentially what happened here with this, the yen carry trade that blew
Sure.
up.
Yeah.
I'll play it on. Do you mind if I play it on double speed just so it's not too tedious?
Sure.
And long. Plus,
Hopefully
I watch
our
everything on double
listeners
speed.
here can feel comfortable with 2x speed.
Right. Well, I'll also put the link in the video itself.
Cool.
1 second. Where is it? All right. 1 second. Okay. Sorry, I'm just trying to get this up here. Okay. Let me know if you can hear this.
The power of AI.
Yes. I'm just gonna watch.
Okay,
this is our sponsor for this episode as well.
To one of the big stories in the market, that is Japan. Its market, as you heard Bob talk about, is one of the main causes for the sell-off. And after a red hot start to the year, Japan's stock market posting its worst day since October 20th, 1987. That sell-off triggering at least part of the global rout that we've seen over the past 24 hours. Kyle Bass, founder and CIO of Heyman Capital Management, warning investors about Japan's economy, specifically regarding its currency and the yen. Kyle, welcome. I feel like we got to stop doing this on nights like this. I'm going to go to Japan in just a second, but I want to follow up on what Steve was just hitting on. The bond market, the bullies of the bond market, they've already been pushing around interest rates. Is the bond market trying to do the work of the Federal Reserve right now?
You know, there's a more technical answer to this, Brian. And late last year, you saw the way the government funds itself go from bonds to bills. And I know that sounds like an arcane idea, but what that did is
Sorry?
It's a lot of alcohol in the background.
Quite a bit.
released another $2 trillion-ish of liquidity into the market going into the elections. And one can think that these bodies are apolitical, but I can tell you that knowing what's gone on behind the scenes, I can tell you that there have been some political currents going on there. And therefore, now the cries for intermediate cuts are coming. Remember, back in...
So that's on the heels of what I was just saying. It doesn't matter what the central banks say; they are going to support the political regime. They need to make the whatever administration is there look good. And so he's saying that there could be cuts coming even before the next meeting for the Fed.
2000, Greenspan in mid-December announced that he was probably going to cut at their January meeting, and it forced him to cut 50 basis points intermeeting on January 3rd, 2001. So even if the Fed's not intending to cut, here's what happens. They say they don't care about the stock market, but every time one of them talks on television, they go watch what the stock market does as a result of them talking. And so if the stock market rolls over and high-end consumption collapses, which is likely to happen, then you have the whole economy rolling over because it's high-end consumption holding the economy up. And that would make the Harris win less likely. So I think you can expect some aggressive Fed cutting between now and the November election.
Okay, you went there, and it's...
which is why I love. I think Kim Carson makes this point that election years, at least in the last high inflation regime that the United States has had an average of 20% up on the stock market at the end of that year, and so I like betting on that.
So there's an interesting overlap in dates here where there are two rate cuts in front of us, which are scheduled at FOMC events, right? And by that I mean the rate cuts themselves aren't scheduled, the meetings are scheduled, but we anticipate that they're likely going to reduce rates. September 18th is the first. Right now, the futures market is stating that there's a 45% chance of a 25 basis point cut and a 54% chance of there being a 50 basis point cut. You're arguing that sometime between now and September 18th, prior to the actual meeting, there will be an emergency rate cut. And
if the market continues to go down.
If it continues to go down. Now, today's conversation is going to be interesting here because while we're on this call, I'm still under the impression that we're up against a pretty strong resistance zone in both the ES and NQ futures, the equities market in general. And I don't think we're going to sustain a rally. I think we're up against the other side of this retrace, and there could be a continuation from here. Let's assume for a moment that I'm right. We break a new low. When do you think the Fed would have to respond to that? And by what degree would they cut rates?
I think it's at least 50 basis points.
Agreed.
And I think it happens in September. So the next quarter, the weakness period is in September. Where the quarterly options end, so volatility would be not very well supplied. In fact, most stock market crashes happen in September, October,
Right.
or
While everyone's on
February, March.
vacation. Yep.
Right.
Okay.
And so if at that period that happens, I think we then get, literally like a day after or whatever, they come out and they say they have to cut 50 basis points in order to support. The reason they're going to give is going to be some sort of like events in the world that they have to, they're never going to say it's because the stock market is broken. They're going to say, or that the financial system is broken. They're going to say some other thing. So you have to wait for some sort of excuse. But I think September is where we see that drop. The drop and then the cut.
So we've got election day on November 5th, and then the next FOMC meeting on November 7th. And right now there's an 83% chance that they'll cut another 25 basis points. Now, if there's an emergency meeting between now and then, do you think there would be a follow-up emergency meeting if markets continue to decline?
No, not a follow-up. I think they'll telegraph, because half of the meeting, the Fed's strength is not really in the cutting of the rates, right? The cutting of the rates is affects the market's liquidity in the markets a year, 18 months after the cut actually occurs, like fully gets fed in there, because it's affecting lenders and creditors and debtors. But their expectations-based policy, which is, I love when they say that, the expectation-based policy is that they're going to jawbone the market so that to cause people to be like, well, we're going to be supported. The Fed puts it there. We can go into the markets and we can make, if anything goes wrong, they're going to come in and save us. And that will be enough. So with the emergency rate cut, which will then also telegraph with whatever they're going to say, that we're going to support the markets no matter what, whatever version of what the Fed speak for that, that'll be the burst of liquidity. So they don't need to then do another emergency cut. But I think then at the meeting, they do cut. Because they're not going to want to do an emergency rate cut in between another set of meetings. So they would cut again. And I see no way at all that Kamala Harris can get on any stage or talk to anybody if the stock market is not up. Because Donald Trump will be able to stay there and go, stock market was all-time highs before and after COVID.
I see your point.
And she can be there like, well, no, inflation's no, they're like, oh, inflation's coming down, yeah, but everything is still expensive, and our portfolios are down 10%, and we don't know what's going to happen in the future. There's no way. I mean, I just don't see how could ever, especially since they can do something about it. And this is not, why would they ever not do that? So that to me seems like a no-brainer. I mean, it seems like the thing to bet on. Yeah, the market's gonna be. I think it has to be all-time highs before any debate happens, before any election occurs.
Interesting. So I know the Fed has, if you watch the reverse repo reports, the Fed has basically unwound its position by almost 90% at this point. Let's say we see continued downside. Do you see the Fed really injecting liquidity back into the Treasury and the bond market?
So they're already starting. We could see that with it's sort of hard to see because they have to inject. The issues that we're having with liquidity is global US dollar liquidity. And we should do a video at some point where we explain like more specifically what that is, because most market participants, when they are retail participants, they think of liquidity as the ability to buy or sell a stock as close to spot as possible in an asset. So like, what's the slippage? Or they think of it as zones of liquidity on a chart where there might be orders for buy and sell. I'm talking about the availability of dollars to finance the creation of new money through the credit system throughout the world. Because of that, most of the dollar system is opaque. It's happening on balance sheets outside of the United States, called the Eurodollar system. And so what I found to be fascinating was that with the crash of the Nikkei and the spike in volatility, what did we see with the dollar? The dollar fell. The dollar usually rises in times of crisis, but it fell, which means that it pretends this idea that liquidity was already starting to be pumped into the market in anticipation for this rollover, which makes sense. Like the volatility issues that Japan was seeing has been talked about in the higher ends of the financial markets for months now. Like, we've known China's had a liquidity problem. We know Japan's had a liquidity problem. Janet Yellen was there trying to figure out what to do in order to balance the system off. So this was known. And so they must have already started to inject liquidity within the global financial system in order to make dollars available to these nations and in order to stabilize the markets. Then we saw the yen, the dollar yen spike. Right, we saw the value of the yen move up. Well, that only happens when the Bank of Japan intervenes in the markets in order to prevent the drop of the yen. And so they're already working behind the scenes in order to introduce liquidity, is what I'm saying.
I see.
And
But it
so
started
we're
with the
gonna start seeing
Japanese
that.
market, though, to be clear. Like, you think the Japanese market has injected liquidity first. I'm
It started with the
asking.
Chinese market.
Oh,
The Japanese one is what we saw with the stock market. The reason why it's hard for us to see in the Chinese market is that it's not transparent to us.
right.
Their issues are with the what is it? 70% of their population is invested in the real estate market, not in the stock market. And then they have all these caps for how things can actually move in their stock market. And so, but what we saw with the they had started mass. I mean, I think they put in. It's something like, I think, $1 trillion worth of renminbi into their markets in order to try to bolster it. And the yuan is always in competition with the yen inside that area of the world, in that part of the euro dollar system. Because, well, I don't want to get too in the weeds of that, but essentially Japan and China almost have to work together in some way, in this hostile way together, in order to keep the system balanced, because it's mutually assured destruction. And so the fact that the Treasury Secretary has to go there in order to negotiate sort of like this peace deal of how we're going to keep the Jenga tower up means that they're already in the liquidity mindset. But it started with China, and we're seeing it reflected in Japan.
Okay, so our audience is on the sidelines here watching us have this high-level global economics conversation, which I find fascinating. And to be clear, I think, Tom, you have a fascinating viewpoint on global economics that I don't have, because I don't read the same things you read. I spend so much time as a technical trader and sort of a U.S. equities fundamental trader that I just kind of ignore a lot of economic stuff. So it's really fascinating asking you these questions, because I think you have a lot of education to provide. Yeah, exactly. So Peter says he feels like I might be bearish, but my leading question here was whether or not governments are injecting liquidity into the market. Because if they are, then it goes back to a theme that Tom and I have talked about more than once on this show, which is how quick recoveries are taking these days. If you go back to COVID, no one anticipated that V-shaped recovery. It was one of the fastest stock market recoveries I think we've seen in a very long time, and we didn't see as big of a drawdown in the event than we've seen in former years. The GFC was like one of the longer periods of drawdown, and sort of an expected period of drawdown that took a long time to recover from. But COVID, that was like one of the best reversal trades you could ever be part of. It was a fantastic drawdown, a really good spot to buy undervalued companies, a really good spot to buy long calls. And if you had taken that trade, you would have seen significant upside in 2020 through 2022. This is another one of those drawdowns where I'm constantly curious. Are governments injecting liquidity into the markets, especially now that the Fed has unwound its position pretty significantly? Are we seeing this opportunity again for another buy the dip opportunity, right? Like that's I think what is on everybody's minds. The whole BTD concept now is like rampant. Everybody's fairly familiar with the concept. If market participants are gaining confidence that we are very quickly recovering from a drawdown in equities, then it's a great buying opportunity. And I want to be looking for which stocks I want to get long on. I already sold into cash. So I'm sitting here waiting, just like the rest of the market, trying to figure out where I want to allocate cash now. And these questions are aimed at determining whether I should be more bullish than I already am, Peter.
Well, that's the part I find to be fascinating, is that I don't think we're going to have a thing like happened in COVID, because that was liquidity injected by every nation all at the same time, no brakes on the thing. I mean, none. And we hadn't seen inflation since the 70s. So they can't do that now. There's not going to be, programs where you can go and get funding for different employees and get $10,000 per head, and there's not going to be any of that stuff happening going on.
Got it.
What I think will happen though is that they're gonna have to inject liquidity and then pull it, and inject liquidity and pull it. They're gonna have to stop and go and stop and go and stop and go, which means I think we'll have this zigzag within the markets where we have all-time highs, super low, all-time highs, super low, all-time highs, super low, and that's the part that to me is the most exciting because one on the TradFi side, stocks, bonds, forex, and all that stuff. People are not going to know what to do, and you're going to have to express your trade, or you're going to be pushed to express your trade in options in order to, one, have access to non-recourse leverage, and two, cap your downside. And on the other side, for the crypto space, they're already used to this. They're already used to up 300%, down 80%, up. They're already used to this sort of thing.
It's true.
And so, which is the next video I want to show you here from actually no, I'm not going to play that one. It's Taleb was talking about on CNBC how look, Bitcoin wasn't a hedge against uncertainty,
right?
And in my head I'm sort of thinking, I mean, I love Taleb, but I think this okay boomer sort of idea of talk about an asset that has taught an entire generation about massive volatility.
Yeah, we've gotten so comfortable with it now. I think people are definitely more comfortable with volatility than ever before. Yeah,
that's right. Yeah. And there are massive opportunities in that space. There's no getting around that. And so when the TradFi space starts behaving like this, then we have to move into the options, and then essentially we're getting the same sort of profile for in crypto in the option space in the TradFi markets. So that's what I'm interested in, and I think it completely changes the type of strategies that we'll see at TradersPost because I think the options will really explode, crypto will really explode, and the way that people go about it won't be this. It'll be trend following in volatility, or not mean version, but reversals in volatility. It'll become more of the asset that people are trading, volatility, as opposed to the price. I think the price will start acting like an RSI indicator. Like it won't even be the thing that you're actually trading. You're trading the underlying volatility of the asset.
Great. Let's get closer to trading price action. Then that's what I'm all about anyway. So,
all right. So I want to end here with I like our predictions. I want the predictions for you think that we could potentially go lower. Oh, let me put it this way. If you think we could go lower on the NASDAQ or Bitcoin, to where do you think we can go? And
yeah, let me clarify. Bitcoin's not showing a bearish trend like NASDAQ is right now. We've got potential to close above a short-term average here on Bitcoin and potentially retest this downward trend or essentially this larger resistance zone around 70K on Bitcoin. So as global liquidity is increasing, it seems like there's still this potential that Bitcoin diverges and becomes less correlated to equities. Right now, on a 20-day rolling basis, Bitcoin is like 91% correlated to the equities market because it shared this drawdown with the market. But it has made what I would consider a little bit faster of a recovery, a little bit stronger of a recovery, and potentially moving upward against some moving averages that I think are pretty critical. In the equities market, however, it's right against that line and it hasn't really pushed above it. And I think that there's still a chance that we see another reversal in equities. Now, whether or not that drags crypto down with it is another question.
Fair enough. For me, for Bitcoin, I was waiting for it to get down to this level over here. So for me, these types of volume weighted moving averages, and this whole time I've been waiting for Bitcoin to get to this area,
right,
this red line.
Right.
And now that it's there, I go, I don't really want to bet that much on the downside. And you can see how much power there is in these trends, because once it touched there, it gained a massive amount of liquidity in order to retrace up. Whereas in the as you were saying, in the NASDAQ, we haven't had that, right? If anything, we're below this area. Like technically, we're futzing around, but this area over here, we bounced off of, which gave us our high up. We came down, and now we're below this area. Yeah. So until we get above there and then confirm it, Like,
it's anyone's guess right now for sure. But there again, like Bitcoin is still in a zone where we're seeing lower highs posted each time, and it's been rejecting off of those resistance zones. You know, you've got some yellow dots where I'm referring to there towards the top. That downward trend is still what has me concerned. So if we are to see a sustained bull market in crypto, we need to cross above that line and start to reject that downtrend.
but isn't this a bull flag?
I've been hearing people refer to it, and I see that pattern for sure. I'm less of a I don't get totally wrapped up in chart patterns as much as I look at price action. So I want to see rejections of support and resistance. And just because it is forming a bull flag doesn't necessarily guarantee that that's the direction we're going to head.
I see. Because this is the type of fake out in this bull flag.
Mm-hmm.
This drop down below and then massively close up above.
Yep.
To me, is what I look for in a bull flag to say,
Yes.
okay, now we're going to break out that way.
Yeah, the pattern gives me confidence, but not enough to actually pull the trigger on a trade yet.
I understand. Well, I like high risk, high reward. So I'm in. All right. Okay, so I need numbers here, Mike, for Bitcoin. What you need to see for Bitcoin? How low do you think it could go if it was going to drop?
That's a good question. So we touched the 0618 retracement on this last move down. That wick at the bottom was literally on the line of those 618, which is the type of retracement I typically look for. I like to see things retraced by to the 0.5 and the 0618 line. So there's a chance that, you know, that still is good confirmation that we have found a healthy retracement in the market, and we're going to be moving to the upside now. If that's the case, I want to see that break first past 70,000, and then a second break past 72. And then if this is an extension of that trend, then here's where I would measure that. Should I share my screen here?
Sure.
Let's see. Let me move this over. Should have had this prepared. Which one's me here? This one. Okay. All right. So here's my viewpoint here. This is our recent retracement. This is our fib line from that low to that high. The retrace we experienced first touched the 0.5, and I thought, oh, okay, but maybe we did find support in this box here, but we broke that, but still retraced to the 0.618 line, right? This zone right here is 0.618. If we are able to continue from here, then what I'd be interested in is the potential of this being an extension. Excuse me. Delete that. So I would be curious on that 3-point where we're going from here. If that was the high and this is now the confirmed low, I would expect that this move pushes us to the 107,000 territory, the 1.2 line. So I think my expectation from here is that if we go any lower, then we touch this long-term trend, right? Which has been around since November of 22, where we found confirmation of this trend right here. And if it does go lower, it would basically show up in this zone right here, pushing us a little bit further down to the 786. And if that's the case, then it's going to maybe make it a little more difficult to get a little bit higher. If price pulls down a little bit more, then maybe we push back into a new territory around 96,000, maybe 100,000. In either case, I think we see 6-figure Bitcoin within the next several weeks if we get confirmation of this being a support zone and a continuation to the upside.
That's what I want to hear. That's exactly what I want to hear. My ideal scenario is that we fall to 44 and then people panic. Just absolutely panic.
So
and
you want to see,
you
want to see the retrace to the 786 then.
I would love that.
Yeah, I'm with
you.
I
would absolutely love that. I really want people to be like, when people aren't completely like, I'm never trading crypto again, then I feel I feel too nervous.
That's it. That's the be greedy when others are fearful moment, right?
That's right.
Yeah.
For on my side, I would say, like I said, 44 is what I would expect as the most for the downside. But I think the upside is going to be far higher than what markets would predict, because I think this is the third bull run, major bull run, and I think it's a breakout of the breakout. So I think we go way, way, way further. So I can expect both on the downside, people go, I never want to be in this again. And then if it gets to 200K, 300K, people go, I can't buy it. How can I buy it here as it continues to rocket? So you get pain on both sides,
which is great, because that sort of profit taking selling is a great liquidity opportunity to keep buying if you're on your way to the upside, right?
Yeah.
Wasn't it Kathy who's predicting around 350 as a base case? I thought I saw that interview recently.
Yeah, I mean, I was thinking 250, but I mean, for crypto, 250, 350. I mean, you could almost be like, okay, it's a rounding error, sort of like with the move that can actually happen,
right?
But then with a retrace to 5 figures, which just completely devastates people. So I mean, that's what I want. This is what I mean, like the crypto as an option. Crypto is a call option on liquidity, but you still get all the volatility of the liquidity. And so this sort of volatility coming to a TradFi market near you real soon.
Fascinating how things have changed in the last 20 years of doing this. This is amazing to see how all these asset classes, of course, are interplay. But the point earlier was people's comfort with volatility. And I'll tell you what, if you're new to markets and you're just getting involved, welcome to the circus. This is sometimes a shit show. I hope you have the fortitude and strength to deal with the ulcers that will come from lost money in these markets, because it is crazy town.
That's right. Excellent. All right, so we'll leave it at that. And yeah, we'll see you next Friday.
Sounds good, Tom. Happy Friday, everyone.